Hello guys, Dividend Enjoyer here, and today I'm going to be doing a stock analysis video of Texas Roadhouse, ticker symbol TXRH. Currently, Texas Roadhouse is up 13.36% over the past year, and the stock currently trades for $194.55. Their market cap is $12.91 billion. Their price to earnings ratio is 29.99. Their annual dividend yield is 1.4%. 52-week high of 206.04 and 52-week low of 148.73, and the quarterly dividend is 68 cents. So overall, you're really getting this kind of closer to the high than you are to the low, but I really think that there's a good opportunity here, and I think that it's still being undervalued because of the amount of growth that we've seen from Texas Roadhouse over the past year in their revenue, in the amount of stores that they're able to open, and just in the amount of money that they're making. It's been looking a lot better. Analysts are kind of more cautious, though. Obviously, the valuation is very high for restaurant chain being at a price to earnings ratio of 29.99. So it may be a little bit pricey right here, depending on your risk tolerance and what you think they're going to be able to do in terms of growth in the future. But yeah, we can see here that analysts currently 18 out of 28 are rating Texas Roadhouse as a hold. The rest are all rating as a buy or a strong buy, with current analyst price targets in the low end of 139.20 to the high end of 220, with the average analyst price target actually being below the current price, which is why they have a hold rating on it. I think that they're incorrect just because I think that this is a very sustainable, high revenue play. I think they're going to be able to continue to grow into the future, and I kind of want to demonstrate why in my DCF model, because I know that this stock has run a very decent amount, especially for a company in this industry, but I really think that they're going to be able to continue the revenue, and I'm going to show you on the DCF model. Here we have my current weighted average cost of capital. You can see that I calculated it to be 6.34%. I did not see any interest expense on the balance sheet according to Yahoo Finance, and I calculated the CAPM for the cost of equity here at 6.762%, and we can see that after we take the market cap and the total debt, take the weighting of both, multiply each of them by their respective costs, we get a weighted average cost of capital of 6.34%. I also really want to say on a side note, I like that so much of the weighting of the actual total value of Texas Roadhouse is equity rated and not debt. Because I really hate when you invest in a company and they're like 20, 30, 40% debt weighted. It's really not a very good sign. So this is a very healthy amount. I do just want to say that. But moving on to the actual valuation side, you can see that we only need a growth rate of 6.5% in order for this stock to still have a little bit of upside for us to squeeze out according to the current price. But I actually think that this is a very low estimate. And my reasoning for that is we have an average revenue growth of 11.24%, but it actually should be higher than that because this trailing 12-month number is just one extra quarter. It's not actually a year after 2024. It's only 3 months. It's only that one extra quarter. So if we look at the rest of these figures, and I don't know why this isn't filled out, so let me fill it out. We can see, and that even brought up our average revenue growth even more to 12.41, even with this outlier that's on the lower side. But we can see that we've had pretty consistent 15 to 16% revenue growth from 2021 to 2024. And I think that we're going to not stay at this aggressive of a number, but I think that it's very plausible that over the next 9 years that we get on average 9% on a very optimistic kind of modeling and perspective, that we get a 9% growth in that free cash flow or just in the revenue in general, right? Over the next 9 years, and we have a perpetual growth rate of 2.5%. We could see that there's 21% upside to this stock right now. So really, if you think that it's going to grow the free cash flow at a rate of like 6.5% or better on average over the next 9 years, which I really think is very possible, because as long as they're able to get more restaurants out and continue to buy some of the franchise-owned or the franchisee owned restaurants, and just continue to put Texas Roadhouses in places where it makes sense, continue to increase the amount of revenue that each one of these restaurants is making. Just continue down the path that they're going. I think that this is very cheap. But if you think that fast food is going to start taking more of their market share, if there are going to be particular challenges for Texas Roadhouse or just that industry as a whole, but I really think that this looks very cheap personally. And that's not financial advice because I'm not a financial advisor. But even if we only have revenue or free cash flow growth on average over the next 9 years of 7%, we can see that the stock is still undervalued by 4.23%. And this is a very, very conservative estimate for a company that has shown that over the past 3 years, they've been able to get in between 15 to 16% revenue growth year over year. So I really think that it's very likely that Texas Roadhouse is actually undervalued despite what the analysts are rating it. I understand that this industry hasn't done as well in the past, but if you actually think about it, this type of restaurant experience is worth way more than a fast food restaurant experience. And I think that one thing that we're really seeing as a big trend is that as fast food raises its prices, consumers are deciding to actually go to these more sit down chain type of restaurants that are slightly a tier above in terms of experience and things of that nature, because they're getting so much more for their dollar at Texas Roadhouse versus a lot of the fast food competitors. So that's kind of my opinion on it. I definitely want to add more Texas Roadhouse, and I appreciate you guys watching this analysis. I think that it's going to be interesting to see what happens in the future. I think that this is a little bit of a risky play just because this industry doesn't have the best margin in the world. And this is a very high price to earnings ratio for this stock, so kind of beware of that. But I think in terms of future growth, I think that they're going to be able to hit those targets and blow it out of the park. And I really think that the next couple of years are going to be very good for long-term investors of Texas Roadhouse at this price. And I think that I'm going to continually add a little bit, and that's not a recommendation to you. It's not financial advice, but yeah, I appreciate you guys watching. Thank you.